Sometimes the economy and interest rates do get out of alignment. I think the more important thing that Mr. Dimon might be hinting at is maybe we can actually decouple the U.S. economy, if I dare say so, from all the trade tariff noise that we're seeing. You know, the day-to-day changes in tweets, et cetera, make investors really uncomfortable, I think, with what direction the economy is going in. And for Mr. Dimon to zero in on the U.S. Treasury rates, I think is pretty smart, because what I think he's implying is, hey, while we've got all this noise going on in this three-ring circus, in the center ring, the U.S. economy looks pretty good, and I'm preparing for higher rates.
Scott, what would 4% do to the economy right now, do you think?
Well, Bill, I think you need tighter capacity, higher inflation, better GDP growth, because certainly you can't extrapolate this, this 4.2% number out into, let's say, a rolling 4 quarters ahead. So, based on the work we're doing, let's say we end the year 3.5, probably on the lower end of that. We just don't see rates moving that much higher. And I think the 10-year, you look at the 10-year now, I mean, it's struggling to stay over 3%. I think we're at 294 right now. And, to me, that's telling you something. I mean, the bond market, which, I'm an equity strategist, but the bond market's usually smarter than stocks. And, that's telling me that we're not going to have a surge in inflation. We're not going to have a consistent surge in economic growth. And I think that's probably the case. We don't have a 2019 GDP number out there right now. Ours is 2.9 for this year. But you're probably going to see a lower GDP number here in the U.S. next year.
So, Scott, let me just follow up there. You don't see rates moving a lot higher. You don't see stocks moving a lot higher either, at least not the S&P 500.
Yeah, Ty, I tell you right now, we've held a 2,800 to 2,900 year-end target range for the S&P 500. We're right in the middle right now. It got there sooner than what we expected. So I'd say, stocks are at or maybe a little ahead of fair value. When we look out over the next 12 months, maybe you're looking at 5% plus a couple percent for dividends. So let's call it a 5 to 7% total return for the S&P 500. So, stocks are not cheap by any stretch, but I still think, we want our investors in this market. We want them leaning toward a continuation of this expansion.
Peter, what about the idea that we could be getting very, very close to an inversion when you look at the yield curve? Does that suggest to you that we should be worried about an economic recession? It typically has in the past.
It typically has, and one of the things that delights me about the prediction of the higher interest rates is that kind of dismisses this whole inverted yield curve silliness, frankly. I don't think that the inverted yield curve in this situation will indicate that we're going into a recession. I mean, all you have to do is look outside your window, frankly, and see that the U.S. economy is doing quite strong. And also, in terms of the S&P, we want to look at valuations. I disagree with your other guest in the sense that we're now, forward rates are about the average PE that it has been over the past 35 years. So I think the economy is robust. I think whether or not you're looking out the window or looking at all your economic data, it still signals that we're full steam ahead.